Hello and welcome to today's premium account short form market update for the 21st of May. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offered presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Global Equity Management and Investor Signals. If I can help you to work in partnership with you to manage your investment portfolio, please contact me on the details on screen. Moving straight into a graph of the US market, the Dow Jones now. Our base case here is that equities move sideways over the next 6 months and we get synchronized global growth in the back half of this year. So we're still well positioned to the long side on equities. One of the key benchmarks to be keeping an eye on is that we're seeing deterioration in the forward yield on the 10-year treasuries, which generally one would expect if global economic growth was likely to pick up, is that we'd start to see a strengthening in this yield on the 10-year treasuries. So we continue to watch this with interest, noting that it's now at the bottom end of its range at 2.5%. And in the weeks and months ahead, we would look for this to find support and eventually start trending higher in order for that thesis that we get into synchronized global GDP growth to be correct. We'd want to see the bond market also starting to sort of see that as the outcome. At the moment, the bond market suggesting that global growth's weakening, and that probably fits in with our short-term view across the next 6 months. We don't think there's going to be the impetus there to really drive equities higher. But ultimately we would be looking for this to turn sometime in June, July, and gradually start trending higher as a forward indicator that global growth will pick up in either the latter part of this year or in early 2015 from a synchronized perspective. So we'd expect to see Europe, for instance, starting to contribute more to the global GDP picture. All right, on that note, let's move straight into the ASX top 50 stocks. And it is a short form webinar, so we'll move through these pretty quickly and focus on the names that we're really allocating capital to. So Amcor we like. I think this stock represents good value, 10% earnings growth, some exposure to US dollars. So if we were to see a flight to safety and the Aussie dollar pulls back, Amcor will get the benefit of converting Aussie dollar earnings to a lower, US dollar earnings to a lower Aussie dollar. So we like Amcor. To put some numbers on this, it's trading about 16 times earnings on a 4.5% dividend yield. We buy it at these levels, up at around $11. We sell the covered calls at $11.25. We collect the August dividend. We collect the call premium. We're driving in excess of 10% cash flow out of Amcor. I think the company has limited downside risks. Across the banking sector, we've just collected the 83-cent dividend in ANZ. I think ANZ, Westpac and NAB all present value down at these levels. I think the prospect of the banks delivering high single-digit headline earnings growth like we've seen in the last 2 years is diminishing. The add back of provision loans has probably run its course. The payout ratios are up at around 70%. I think top-line revenue growth 3%. Top-line revenue growth of around 4%, cost growth at around 2%. I think what we're likely to see is these stocks that have just paid their dividends adjust and maybe provide 5% capital growth, at which time then we need to sell the covered calls and complement that 5% dividend yield with the extra cash flow from the call premium. But for new money that's available, happy to take a look at ANZ at or near these levels. ASX, I think this is a must-have in portfolios. The prospect of the company being involved in some corporate action or takeover proposal in the year or two ahead, I think underpins it from a downside risk perspective. At 18 times earnings, 5% dividend yield, it's not cheap, but I do see it as a fairly defensive cash flow opportunity for portfolios. Own the stock, sell the covered call, turn this 5% dividend yield into 10 to 12% cash flow, and have the opportunity for some capital growth up to around $38.50. The company should grow earnings about 5 to 10%. AZJ, I think this is a name to have in portfolios. It's sold off recently on the back of the announcement that they will be teaming up with Bayer Steel to expand the possibility of their haulage of iron ore in the Pilbara region. There's some concerns around the capital expenditure that the company will have associated with that project. We've seen a slight adjustment. I think it's a buying opportunity. Any further dip down to 480, I think we become aggressive with buying. I think the stock's worth $5, should grow earnings. Maybe the market's a bit bullish, looking for 20% earnings growth. Certainly 10 to 15% earning growth still makes an attractive asset over the next year or two. Probably seeing the best days for AZJ from a share price standpoint for the short term, but I do think it's a consolidation from here and limited downside risk, so continue to like AZJ. BHP, the only resource stock we hold in client portfolios. When you consider what's happened to Fortescue and Rio over the last 3 months, we've played it right. The money's in BHP. We've sold the covered calls over it. The story with BHP is the company should buy back shares, announce a share buyback around August, and I think that continues to underpin BHP relative to the other resources. Brambles, I think like Amcor, this makes sense to own it. It's expensive, but having exposure to US dollar earnings, having the exposure to Brambles revenue streams in US and Europe makes sense. The stock's trading at about a 3.5% dividend yield. We own it at these levels. We sell the tight covered calls, kicks that cash flow from 3.5% up to around 10%. And again, it's one of those names that we see largely moving sideways. If there was any sell-off in equity markets and the Aussie dollar pulls back, Brambles a beneficiary of that. Coca-Cola, a little bit of short covering here at the moment. I think Coca-Cola, as I've alluded to in previous recordings, following the shareholder meeting last week in Sydney, we're always expecting the stock to get a little bit of positive momentum following that. Up to around 10.50 really caps the upside in Coca-Cola. That puts the stock back on sort of a low 5% dividend yield, and with limited earnings growth in the short term, I think it consolidates and moves sideways between 10 and 10.50. So happy to sell calls and complement that dividend at or near those levels. Computershare, we'll take a look at this on a pullback. It's expensive up here. Grow earnings maybe 5 to 10%. We want to be owners of it back at around around 11.50. I should just cover Crown. I think that starts to represent value at the bottom of this sell-off. It's a trade from $15.50 back up to $17. Here we go, Fortescue. We're seeing capitulation in these iron ore names, in particular Fortescue and Rio. I think you need to sort of have a bit of a counter crowd view there, that as this capitulation occurs, I think it starts to present a buying opportunity. We're not right there at the moment, but certainly on the radar. GPT taking profit up here at 390. We won't take another look at this until it's 370. Any of these property plays that where the yields compress too much, on some of the higher growth names, the yields can compress down to around 4%. I don't put GPT in that group. I think at around 6% yield, it's a buy again, so we need to see it pull back to 370 before we step back in there. IPL announced their earnings, roughly underlying earnings growth around 7%, just paid their dividend of around 3.5 cents. So from a yield perspective on a full year basis puts the stock about 4.5%. I think it's a buy on the dip here, but not looking for much in the way of upside beyond $3. I think it's a 2015 real recovery story from an earnings perspective. James Hardie comes back onto the radar. I'll comment more on this in the coming weeks and we'll pull apart the earnings, but certainly at this level it starts to come back on the radar again. Lendlease, very expensive up here, hard to justify owning it on a 3% dividend yield. The earnings growth certainly will come through over the next 2 to 3 years, but we're only buyers of it on a pullback to around $12 as our entry level there on Lendlease. NABAS with Westpac and ANZ at the moment, I think the buying opportunities could push up higher by around 5%, and then we look to sell the covered calls. We've just collected the dividend on NAB of around 99 cents. Origin, expensive up here on any measure. The stock's trading 20 times earnings on a 3% dividend yield. Next year should be a bumper earnings result for Origin into 2015, but I really think at around 15.50, even going out 6 months, caps the upside. So we're pretty aggressive. We're selling calls over Origin and kicking that cash flow from sort of 3% up to 10% and allowing for some capital growth. But we do own it at lower levels, just getting up to the top end of the valuation range. Oil Search, strong performer. We like Oil Search, Santos, Origin and Woodside Petroleum we've just started to take profit on. Ramsay Healthcare on the radar. It's one of those names that we'll look at in the weeks ahead and pull apart the financials, but certainly interesting after the recent sell-off. Capitulation here in Rio, as with Fortescue, could have a little bit more to run, but I think we're getting to a point where these names start to look interesting again. Stocklands pays its dividend at the end of next month, roughly 12 cents. I think it makes sense to own it coming into the dividend, sell the covered calls up at around $4. The company will grow earnings around 6%. They've just reaffirmed that. I don't see too much risk to the downside in Stocklands. Sonic Healthcare, it's a buy down here at $17. That puts the stock back on a 5% dividend yield. They should grow earnings around 5%, even in light of the impact of the budget changes could have on the company. We're buyers of it here, selling calls at the $18.50, collecting the upcoming dividend. It's a good cash flow contributor to portfolios on the basis that it moves sideways. Santos, we own it at lower levels. We sold the $14.50 calls, gives us an effective exit price at $15. That's out to around August, September. So we'll hold in there. We'll either collect the upcoming dividend on the basis that the stock moves sideways, the call will wind off, and we'll resell that again in December. So it's turning a relatively low-yielding stock into about 10% cash flow, but more than likely we'll see Santos delivered under that covered call at around $14.50, giving us an effective exit price at $15 after owning it at lower levels. On a relative basis, Santos I think is cheaper than Oil Search and Origin, but the real uptick in dividend and payout of Santos may come a little bit later than some of the other names. Transurban, another one that pays its dividend in June. That'll be around about 17 cents. We own it at lower levels. I think it still makes sense to own Transurban on a 2 to 3 year basis. I can still see Transurban growing dividend yield by at least 5% when you take into account the recent comments from the RBA that Australian interest rates are going to stay low. I think you're going to see superannuation and just capital in general continue to have exposure to Transurban, so we continue to like that name for portfolios. That's really the same story here for Telstra. I think at around $5.50 it starts to run into resistance. That puts it back below a 5% yield, but I really think coming into the August dividend it can push up maybe another 10 cents higher than where it is at the moment. Westpac, interesting as with the other three banks, happy to take a look at them on this dip, reallocate capital, look for about a 5% move higher, then sell the covered calls. WDC is our preferred property play, should grow earnings about 3 to 5%, but I think longer term this is the lower risk property play. We own it at lower levels. Our target was to see the stock trade up to $11. We're selling the $11.50 calls. That would put it back on below a 4% dividend yield. I don't think the stock can sustain that, so it's a buy right up at these levels. Wesfarmers, any opportunity to buy on a sell-off. I think it's good value down here at $41. It's expensive up at $44. It's likely to track sideways. Own it, sell the covered calls, collect 10% cash flow, and give yourself an opportunity to lock in some capital gain if it get knocked out on the top side of that trend. And then finally, Woolworths, Woodside Petroleum, I should say, after owning it at lower levels, taking profit here at the moment, but pretty comfortable that there's not a lot of downside risk in Woodside. It's really just a matter of locking in some gains, but I think the stock probably bounced sideways. Not a lot in the way of earnings growth, but a well-supported dividend yield and the prospect of them returning capital if they're unable to find an alternative investment opportunity over the next sort of 12 months. So keep an eye on announcements out of Woodside for the prospect of further return of capital. And WRT, the shareholder vote takes place on the 29th of May, so we'll keep an eye on that as to whether we see the spin-off of the Australian property assets out of WDC merging with WRT, albeit there are some continuing pushback from shareholders at present around that transaction, so we'll watch that with interest. Thank you for listening in, and if I can help you with working with you in partnership to manage your portfolio around a portfolio of ASX top 50 stocks utilising call options to enhance portfolio returns, please contact me on the details on screen.